Thank you very much for coming to this section. I hope you have not been exhausted by now. This topic is very important. It's about enforcement. I think you would know that the SFC has taken the issue of enforcement very seriously for the last few years. And in fact, stringent and vigorous enforcement has more or less become a culture in the securities market in Hong Kong. Enforcement is not something that, and we'll be discussing that with our panelists, it's not something that to be brushed aside because, as experience shows, it does affect the bottom line of financial companies, not only in terms of penalties, but also other costs to be provided for in terms of compliance, regulation, and all that. And today we are very lucky to have four very distinguished panelists to come to share with us their experience. First, we have Mr. Peter Kell. Now, Peter is the Deputy Chairman of the Australian Securities and Investment Commission with substantial experience in consumer protection. Now, Hong Kong does owe quite a great gratitude to ASIC for both the infrastructure and also their tenant to come to Hong Kong to help us and to bring in the knowledge and experience. So we could have Peter to share with us his regulatory experience in Australia from the enforcement perspective. And sitting right next to me is Meena Datwani. Meena is a lawyer by training and used to be the executive director of the Banking Conduct Department and now Director General of the Enforcement Department of the Hong Kong Monetary Authority. Now she will bring an angle from the banking perspective. Now that many banks are being regulated and they also have securities and funds and all that, it's a very substantial sector of the market. And Meena will bring us very substantial experience in sharing her wisdom in financial regulations in Hong Kong and where we take it from there. Then we have Mr. Joseph Longo. Joe used to be a senior enforcement officer, surprising, also from ASIC. And he has now jumped ship from the regulators, and he is now the general counsel of Deutsche Bank for the UK after he left ASIC. And he can share with us his views both as a senior legal officer of a bank and a former securities regulator. So he has the benefit of both branch of the profession, from the regulator and from the regulated. So he will be able to give us a lot of insight. And finally, we have the privilege to have Mr. Matthew Newick. Matthew is a litigation solicitor specialized in financial disputes and regulation enforcement. And he is now a partner at Clifford Chance. And Matthew will share with us his wisdom from the perspective of a defense lawyer's point of view. And there's a reason why we would reserve Matthew as the last speaker, because all the regulators will speak about that, and then Matthew will tell us how he's going to defend the position from his client's perspective. Today we have three topics, and I think those topics are actually of very pertinent value. The first topic asks the question, have enforcement actions had an impact on the culture of financial industry? I'm actually very pleased with this topic because it talks about a culture. A culture is very difficult to build up, and once a culture is built up, then it's very important in terms of the operation of the financial industry as a whole. We actually have a polling exercise, so you can vote, actually. So no problem about not having one man, one vote here, one person, one vote. You can all vote to decide what you want to choose. The second question is, does strong enforcement stifle market competitiveness? There's always a concern whether there's over-regulation, over-enforcement and all that. And from the regulator's point of view, we'd like to listen to your views and also the expert views of our panelists. And the final topic, which will be of most relevance in terms of practical advice and maybe something that you pocket away from this seminar, is what should market participants do to reduce exposure to such action? In other words, what are the tips, what are the actions that you need to do? And if anything that you can get some free legal advice or free strategic advice from this strong panelists, that's the third question that you may be interested. Now, without further ado, can I invite Meena to share her views? Actually, I'm told that there should be some polling result in respect of the first question. I'm not quite sure whether that is available or not. But if not, perhaps we can invite Meena to share her view on her experience as a former executive director and current director general, enforcement of the Hong Kong banking regulator, on this question about have enforcement actions affected the culture of the financial industry. Actually, the result has just come out. Predominantly, 69% answer yes, they are a strong deterrent. I think exactly, it's changing. It's now 67%. And the second question gets the result maybe a bit, but ultimately it's all about profits. And the third one is enforcement action, totally relevant, 3%, right? So we can discard that. So we're happy that people take enforcement quite seriously. Now, Meena, how do you read this polling result?
Well, thank you very much, first of all, for inviting me to speak on a subject that is really dear to my heart. Being the head of enforcement, obviously, I'm really focused on enforcement, but I actually see enforcement not so much as an end in itself, but a means to an end. And the end being a change in the culture of the industry. So I'm really happy that the industry thinks that, our job is doing the trick, and this is encouragement for more enforcement, I think. But actually, my observation is, now I've been in the MA doing policy work for since 2010, and I really think that the culture of the industry is evolving. And this is the thing about the culture, that it can evolve, and enforcement and other aspects of our work do impact on the culture of banks. And I'm seeing an emerging culture of compliance. But what I would really like to see is a culture of ethics, a firmly rooted culture of ethics, because I think that's really going to ensure the right outcomes, both for consumers as well as the market. Because there are a lot of gray areas. Not everything is black and white. And if you have the right ethical culture in place, then you will know how to act so that there's fairness even in those situations. Banks, for instance, will produce products that are not really designed for their own benefit, but will also take into account the needs of the consumer. So I really feel that enforcement does have an impact on culture, but not in itself, not just by itself. And the reason I say this is you can see that there's more and more enforcement. So it suggests that enforcement is not the only solution. What we need to do is take a holistic approach. We have a lot of tools in our toolkit. We have regulation, we have supervision, and then we have enforcement. We have to use all of those tools to bring the desired outcome. And we can't do it alone. We need other stakeholders to be involved, particularly senior management. And I'm sure we've spoken in the other panels a lot about corporate governance. That is also a very, very important subject. Enforcement is important because it has a deterrent effect, not just for the firm, but also for the industry, because enforcement outcomes are publicized. However, I feel that when it comes to fining firms, the impact may be limited because it might just be seen as a way of doing business. It's cost of doing business. Having said that, the beauty about the banks in Hong Kong is that they're really concerned about their reputation, and their reputation hasn't been tarnished so much that they don't really care about their reputations, which is not the case in some of the other jurisdictions, I'm told. But what in my view would be more effective if there was more emphasis on individual accountability. And Enforcement actions against individuals who have committed misconduct and senior management who have failed in their responsibilities will have a greater deterrent effect, and particularly in driving cultural change. However, due to the complexity of oversight and management and decision-making processes, it may be difficult to allocate individual responsibility for any failure to prevent or detect misconduct. Of course, we know that the UK has introduced a senior manager regime, which was originally going to include a presumption of responsibility, which would have made it easier for senior managers to be accountable in their areas of responsibility. However, due to an outcry by the industry, the statutory duty of responsibility has replaced the presumption of responsibility, and the onus will be on the regulators to show that the senior manager did not exercise reasonable care or did not take reasonable steps to prevent the breach by his staff, his or her staff. But let me go back to the position in Hong Kong, and particularly the HKMA, and illustrate how our investigation and enforcement work has an impact on culture of banks. You may recall that a couple of years ago, we commenced a HIBOR investigation of 10 banks. And we did find evidence of misconduct in the submission of HIBOR rates by just one bank. But there was not the sort of same collusion that was found overseas. So no collusion to rig the HIBOR fixing. So while the conduct that we found had negligible impact on the HIBOR fixing, what we did discover was there was an attempt when the bank discovered this misconduct not to report it to the HKMA. And we took real offense with that. And we took a really hard line on that. Went back to the bank and said, you have to take disciplinary action against the people who are responsible for the misconduct, as well as the cover-up. And since then, we've noticed that the industry has been very, very vigilant about self-reporting breaches. We established an email for a self-report of conduct incidents and have seen a material increase in such reports. So I mentioned that we have a lot of tools in our toolkit. So on top of enforcement, supervision is also very important. And I can speak from experience because I served as the head of banking conduct for 4.5 years. And I found that our role actually enabled us to provide early warnings, encourage corrective actions, and refrain from using enforcement measures if corrective actions were taken. After all, prevention is better than cure. We also, what we were able to do was share some of the good practices and deficiencies with the industry. And a lot of practitioners find this very useful because, after all, we have high-level principles, and if we share good practices or things that we don't find acceptable, then it's really, really helpful for them to get their act in order. And I want to give you another example of how really when you have supervision and you have enforcement hand in hand, that's really when you see a real impact. Last few years in the area of AML and CFT, we've really increased our resources and done a lot of on-sites and issued considerable guidance to the industry to ensure banks have effective AML and CFT systems and controls in place to detect and report suspicious transactions. And these efforts have not gone unrewarded. Many banks in Hong Kong have taken significant steps to beef up their systems, and they understand their risks better, and they have improved their systems and reported suspicious transactions to the JFIU. This is really tricky because, of the ever innovative ways of money laundering and terrorist financing. But we've noticed that the banks have really increased their capacity in this area. And in 2014, for instance, 83% of all STRs were reported by the banks. And actually, there's been an increase in the number of such reports. This really shows a cultural shift. And also this was reinforced by the fact that we were the first regulatory authority in Hong Kong to take action, disciplinary action against the bank under the AMLO, anti-money laundering, or for short, ordinance, because of its failure to conduct customer due diligence and failure in its internal control systems. We reprimanded the bank, fined it $7.5 million, and asked for a remedial plan. And I'm told by my friends in the audit and the banking industries that this has really led to, the banks seeking, scrambling for help to get their systems in order. I also want to end by giving another example of where supervision is really important. When I joined the Banking Conduct Department in 2010, we had surveillance and we realized that there was a product out there that was so popular with retail customers. It was called Accumulator, which some people have dubbed I kill you later, and it really does kill you later. Because the way this product is designed is that, the upside is really limited, but the downside is a bottomless pit. And so we really gave a lot of warnings to the banks. We said, this is not suitable for retail investors, and you should give it the highest risk rating. I wrote an article, inside article, which is posted on our website to warn consumers. This has really helped us because I loathe to think what would happen in this environment if this had been sold whole scale. I think it would have been a repeat of the Lehman Brothers saga. But the thing is that it continues to be sold to PIs, professional investors and corporates, particularly FX accumulators in RMB. And a lot of SMEs have bought these products because, it was like a one-way bet with the RMB, only kept going up. But we did warn the banks that they had to be really, really careful and make sure that there was a genuine need for such products and make sure that the customer isn't overexposed, there isn't a concentration. We said that you should use, calculate the concentration risk using very robust methods and framework. And if not, then take the whole value of the contract as a maximum notional exposure. And at the time, we got a lot of representations from the banks saying, this is ridiculous. The RMB is such a stable currency. How could this be the case? It'll never happen. And we stood our ground, and thank goodness, because despite that, we've received 41 complaints of people who've lost firms, small firms who've lost millions, hundreds of millions of dollars. And if we hadn't done that, I dread to think what would have happened. So I hope I have managed to illustrate how enforcement plus regulation and supervision is the way to go.
Thank you, Meena. You raised a very good issue about ethics. Joe, how do you see market participants, for example, you from a banker, general advisor to Deutsche Bank, this conflict between having to meet targets, having to make the profit projections, things like that, and on the other hand, ethical considerations, and also from your consideration as general counsel to a bank, do you have any response to Meena's comments?
Well, I think a couple of points. The first is I think from a regional and global perspective, it's clear that the enforcement efforts and activities of regulators everywhere are really having an impact on how bankers think and behave in banks. And the way I think about enforcement, it's a regulator asserting its will and presence on the industry. And I think for a lot of bankers, until relatively recently, the idea of going to jail or being held accountable in a very public fashion was a rather academic or theoretical prospect. But I think over the last 5 or 7 years, the senior bankers now appreciate that the enforcement activity of regulators around the world can actually affect them personally. So I think they're taking that a lot more seriously than they did perhaps as recently as 5 or 7 years ago. So I think enforcement does matter, and it does actually concentrate the mind of supervisors and managers and make people feel that they are actually accountable for what they say and do. And so even though you may not have done anything wrong, I think there's now a widespread understanding that you could be asked to give evidence under oath as part of an investigation or as part of an internal investigation. And I think that's very common now. It's very common now for bankers or people in banks to be questioned by an auditor or by an internal investigation or by a regulator. So that's really changed the way people come to work every day, frankly. Now then, the question you raise about, the tension between, needing to meet a budget revenue and having to, behave on the other hand, I think that's a real tension. I don't think people come to work every day and may articulate it quite that way. But I think the banks are still there to be profitable. And that is actually in the interests of society and the general community and shareholders. We want our banks to be profitable and robust. So none of us should make any apology for that. But the critical question is that those profits are well made and that they're made lawfully and, as you say, ethically. And I think the issue is that there's a huge adjustment going on, that as you come to work every day, you have to be very mindful of policies, procedures, internal controls, and run a profitable business. And so I think the kind of banker we will need now and in the future is one that's not only entrepreneurial and innovative, which is what we want in our bankers, but people who also have a strong managerial sense and who have a respect for and know how to engage with controls. And so I think what's happening in the industry now is you're attracting a lot more of that kind of person and less of the person who's solely interested in making money and being entrepreneurial. So that's, I think, an industry-wide transformation that we're still going through.
Right. Matthew, from the perspective of a defense lawyer, what's your comment or your views on the cultural change in respect of more and more enforcement actions by regulators, be it from monetary regulators, securities regulators? What is your general observation over the years?
But if I could just start by making an observation about what I think culture means when we talk about it in this context. The definition I like most is one I came across in the G30 publication on banking conduct and conduct risk, banking conduct and culture, which came out in the middle of last year. And there was a line in there about culture being what you do when no one is watching. Mm-hmm. And that was actually the first time I'd seen that, and I immediately embraced it as my definition of culture. I had a bit of a shock when I later saw it attributed to a speech from Bob Diamond in 2011. And he's not the most fashionable authority on culture, so I took stock and still like it very much as a definition in any event. So it's a definition I think encapsulates very nicely the concepts, because it's really about not doing what you can get away with, but doing what's the right thing by the customer, most particularly by the firm and by the regulators and the industry as a whole. So I think it captures the concept quite nicely. To answer the direct question, I do, from my defence lawyer's perspective, think that enforcement action, as Joe was saying and as Meena said, does have quite a big impact on the culture within institutions, and I've seen that particularly over the last few years, post-2008, obviously. So if I just think about the practical things I see inside client organisations, I see senior management spending a lot of time and effort and money on issues about culture, and that includes investment in programs designed to enhance culture within their organisations. So I see that positive action. I see lower tolerance for bad conduct within financial institutions. Sometimes I think that lower tolerance has gone too far, and there is a blurring of the lines between unethical, bad conduct and honest mistakes. And I think that's something the industry needs to get to grips with, because it has consequences that we can come back to later if we get time. And I also see more awareness from individuals about the consequences of misconduct within the organisations for them. So in a sense, what I mean by that is I see much greater recognition from ROs about what the R in RO stands for. People recognise that it means responsible. And I think they understand the consequences of that. The interesting thing about these things that I see in practice is I see them in Hong Kong, even though, as Meena was saying, our fines here are very, very much lower if we're talking about the SFC than they are in a global context. And in the case of the HKMA, no fining power at all, except in the AMLO context. And so despite that, I see institutions taking enforcement risk very, very seriously. And I think what that means is that the real enforcement deterrent apart from the eye-watering numbers that you do tend to get elsewhere. The real enforcement deterrent is reputation risk and license risk. In other words, the risk of losing the privilege to do the business you're doing.
Yeah.
And I think those are what have the big impact. And if I could just give a practical example from recent experience about the positive impact of enforcement action on the regulated community, I think it's the Nomura self-reporting case last year, where what we'd been seeing over quite some time was messages of increased expectations on part of both the SFC and the HKMA about their expectations on self-reporting. That message had been coming through loud and clear. I, like everyone else, had been predicting that enforcement action would follow in the fullness of time, and then sure enough, that case emerged last year. Now, it was accompanied by typically robust statements by Mark Stewart in the press release to the effect that what this means is that you need to report immediately, without investigation, and without taking legal advice. Now, I think he was wrong. I think that was a significant overstatement of the position, because there are obviously situations in which it's appropriate to spend a little time to work out what the issue is and, if necessary, take legal advice. So I think there's an element of overstatement there, but nonetheless, the message of the package of the pre-enforcement message, the Nomura case itself, and the press that went with it, I think then had quite a major impact on the attitude of the industry to self-reporting, and the culture of escalation I have seen change quite markedly internally. So I think that's a practical example of the impact. The one thing I would add here is that although I do see major impact of enforcement action on culture and behaviour internally, I think there are a few provisos. One proviso is that I don't think enforcement is the only answer, to echo what Meena was saying before. So the stick, I'm sure James Shipton will agree with me about this, so the stick of enforcement is one thing, but the carrots are really important in this context as well. And one of the things, I'm not a behavioural economist by any stretch of the imagination, or any kind of economist, unlike Peter, but what I see from experience is if you want to work out how people will behave, you look at their incentives. And I think that's an area in which the industry still has a way to go to get the incentives right. I think there's still too much decision-making that is driven by incentives that are more short-term in focus than long-term in focus. And I often think that if you really wanted to create the incentives for ethical behaviour, you would say to yourself, right, I'm going to pay my banker who makes me 100 but is ethically reliable more than my banker who's ethically a bit edgy and makes me 150. But no poll on this, you'll be pleased to know, but I wonder how often that actually happens in practice still. So I think that's an observation. I was going to have one other proviso, but I don't think I've got time for it, so I'll hand it back. But the other proviso was, I think, that I won't develop the point, but I'll lay down the marker, is that although enforcement action is a very important weapon, I think that the license to use it on the part of the HKM and SFC in our context comes with conditions, and I'm not convinced that we're applying the conditions correctly right now in a few respects. One is a sense of due process, and the other is a sense of some empathy for the institutions that are under enforcement action and investigative activity. I could talk for ages about those topics, but I won't.
Yeah, you can reserve that for your second topic. Peter, I saw you nodding your head when Matthew was speaking. We all come back to you. You are the regulator. So from a regulator perspective, what do you see about this cultural change as far as enforcement is concerned to the market? What do you want to see? Is it an effective way from the Australians' experience?
Thank you, William. And can I just say at the outset that William should have told you that we can identify who's voted for what option. So those 3% of you out there that said enforcement is irrelevant, we know who you are. Ashley will be meeting you at the door on the way out, just to ensure that you have an appropriate culture from now on.
And you can have my business card as well.
So just to start off there on the right note, look, have enforcement actions affected the culture of the financial industry? That's a big question. when you're talking about the culture of an entire industry. So in approaching it from a perspective that Matthew articulated, what do we mean by culture in this context? Well, I think in some ways we're talking about some of what you might regard as the negative aspects of culture that were more prevalent in the industry a few years ago, where it was seen as appropriate to have remuneration structures that incentivised people to act against the interests of their clients or to engage in misconduct, where it was seen as appropriate to push products that were high risk onto people who didn't understand those risks, where it was seen as negative or unacceptable in some ways if you raised concerns or blew the whistle on misconduct or problematic behaviour. And that sort of culture that led in many ways to the problems that we're all familiar with. Have those things changed? Well, I think it would be naive to suggest that all those things are where we want them to be. But have we seen significant improvements over the last 10 years or so? My suggestion would be yes, we have. And that there have been a range of contributors to those improvements, but one of them has been more robust and more effective enforcement by regulators. In particular, I think where regulators have demonstrated that they're going to approach enforcement in a systemic way. So it's not just going to be a one-off. If there's a pattern of conduct across an industry, then there well may be a pattern of cases, and that helps to demonstrate that there's a seriousness about enforcement, but also that the industry as a whole has to change. And this, to use an example from Australia, is a process that we're seeing that is helping to change some of the problems in the investment advisory industry, where very poor investment advice was provided to retail investors. Are we where we want to be? Not yet, but we're on that journey. To pick up Matthew's point about carrot, I also think in some cases enforcement actions can have that carrot effect as well. So in Australia, we have signalled very clearly that if firms come forward, if they report instances where there has been misconduct and they are able to demonstrate that they are going to put in place actions to remediate clients, then the enforcement response won't be as tough as it would if there's been a failure to report those sorts of actions. But I also echo the comments that others have made that enforcement alone is not going to be the driver for culture. In fact, if you rely purely on external drivers to fix culture, then you really do have problems. A lot of that cultural change has to come from within firms as well.
Thank you very much, Peter. Now it's time for us to look at the polling result of the second question. Our second topic is, does strong enforcement stifle market competitiveness? We have the polling result. The overwhelming majority is no. A solid regulatory system is a must to attract investment. So this is good news for the SFC. So we now can go out and adopt even stronger enforcement on the strength of this survey. Now,
Excuse me, it's also good for the HKMA.
okay, yeah. Now, but Peter, from the perspective of a regulator, I mean, there's always this concern about over-regulation, about markets saying that there are too much enforcement and we cannot do business, right? Now, I will be asking Matthew to add his caveat on that. But what's your view on this observation from the market about the negative effect, if any, of very strong enforcement?
Well, I would like to make the case that strong enforcement can actually facilitate more competitive markets. But to start with, what do we mean by competition in this context? I don't think it's particularly mysterious. When we're talking about competition working well, we're talking about markets that work effectively and efficiently, and markets that deliver long-term benefits to the end users that are present in those markets. So that's what we're really talking about, markets working well. That's what we want to see, and competition underpins effective markets. So the first point I'd make there is, at the highest level, efficient and competitive markets are underpinned by the rule of law. Efficient and competitive markets must have an effective legal framework. And an effective legal framework requires effective enforcement that is consistent, enforcement that is clearly demonstrated, enforcement that takes poor players out of the market. And that's true of financial markets or any market. So if you want markets to work well, you need a robust legal infrastructure, and a key part of that is effective enforcement. The second point I'd make is that many of the problems that we've seen in financial markets, including a lot of the systemic misconduct, is caused by a failure of competition, by market failures. And financial markets, because they tend to be more complex, are more prone to what I'd call collective action problems. If your competitor is selling a product and gaining market share at your expense, even if you know that product is not getting to the right people, there's always a very strong pressure to engage in the same sort of conduct. In the Australian, I'm sure you've seen it here, we've certainly seen it in the Australian context. For example, there were a whole range of products being pushed to retail investors that were being described as capital protected or capital guaranteed, which was fantastic, except you could lose 100% of your capital. And we thought that was not exactly appropriate and in fact misleading in some circumstances. And part of our response to that was to take some enforcement action. And talking to some of the firms afterwards, they were, in a sense, almost relieved that the regulator was coming in to reset the ground rules so that everyone could compete on a fairer and more reasonable basis. So I think if enforcement is doing its job properly, it can actually facilitate an appropriately competitive market. The third observation I'd make is it's interesting that in many jurisdictions, I'm not sure about Hong Kong, but in many jurisdictions, the economic regulator with the strongest enforcement powers and the strongest penalty regime is not the financial services regulator, but the competition regulator. Now that tells you something, I think, that in many jurisdictions, it's actually the regulator that has as their key objective the promotion of competition and the maintenance of competition, has the strongest enforcement and penalty provisions when it comes to comparable economic regulators. And you see this in some very significant outcomes in the US and Europe, and obviously some of the benchmark actions fell into that area. So that, I think, underlines the importance of effective regulation and ensuring effective enforcement and ensuring that competition is maintained. The final point I want to make is to just, if you like, flip that question and ask, instead of is strong enforcement inhibiting competition, to ask, does weak enforcement encourage competition? Was it too much enforcement that was driving some of the very poor comes from a competitive perspective that led up to the GFC. I think it was in some ways an absence of effective enforcement that was allowing compliant firms to compete on a level playing field with those that were non-compliant, who ought to have been driven from the industry.
Peter, that's a very insightful analysis from multi-dimensions. We're grateful. As far as Hong Kong is concerned, we only have the Competition Commission this year. So its effect we have yet to be seen as to how they encourage, promote competition. Matthew, you are about to talk about your caveats and your another dimension from the perspective of does strong enforcement stifle market competition?
I think, as with all these things, it's a question of degree. I don't disagree with any of the sort of the philosophical points that Peter's made, or nor indeed any of the practical ones. If I think, though, about the practical cause and effect of what I would describe in the last few years, thinking globally as ultra-aggressive enforcement, if I think about the practical consequences that I've seen of that in financial institutions, I think there have been some negative consequences, not just positive consequences. And we talked in the first question about the positive consequences. One example is that I think such has been the scale and complexity of the investigations and enforcement action from multiple regulators that have been occupying the minds of senior managers and less senior managers, that the eye has been taken off the ball to some extent, in my view, in terms of doing the business, which is finding solutions for customers. So I do see decision-making that is very heavily driven by the enforcement activity of the day rather than by innovative risk-taking, innovative, responsible risk-taking. So that is a practical implication I've seen. I've also seen, along the same theme, definitely reduced appetite for risk, definitely reduced innovation, and sort of paralyzing fear of making mistakes. And that's not just at the senior end of town, but at the bottom, at the junior end of employees as well. And I've seen some firms take such a conservative approach when faced with this siege of enforcement activity about what they can and can't do, what they should and shouldn't do, that they end up frustrating their clients who ultimately are looking to them for innovative solutions and ideas to increase yield, and they're not getting them. So I see the positive behavior of giving ideas to clients, recommending appropriate things to clients, stifled somewhat in practice. Now, there's a good question to pose about how much innovation and how much risk-taking we want in this industry in circumstances where the pre-crisis years undoubtedly had too much of both. But actually, I think the problem with the industry is not about innovation. It's not about risk-taking. It's about how you incentivize those in whose hands you place the innovative ideas and the risk appetite, and how they meet client needs. So responsible innovation and responsible risk-taking are what the industry is all about. Do we really want an industry, for example, that loses such innovation? What would the industry be like? What would the world be like if we didn't have derivatives, for example? And that's a good philosophical debate, but it seems to be no one would seriously argue that derivatives are a bad thing properly used. One slightly curious consequence of enforcement activity that I've seen that in a way troubles me more than any of the others is I have seen a reluctance, particularly at the junior end, to escalate issues that should be escalated. And that's despite very acute awareness of the fact that it probably is the right thing to do to escalate, that senior management expects you to escalate. And the reason I see that reluctance is because I think there's a fear of the consequence. The stakes have got so high. And I think part of that is driven by a lack of trust that senior management or the regulators will respond proportionately. It goes back to that point I was making before, this distinction between people taking responsible risks, being innovative on the one hand, and making honest mistakes in the course of doing so, and on the other hand, being dishonest or unethical or failing to meet client needs, ending up thinking what the whole purpose of the employee being there is to serve the client, and forgetting about that. Just to give you an example, I saw an example recently where a trader had routinely conducted a particular sort of trade because his boss had once told him that was an appropriate way of dealing with the particular scenario, which happened to be a lack of liquidity in a particular product. the trader came to appreciate that it was probably not appropriate. And the supervisor left, but the trader did nothing to escalate that issue to the new supervisor or to anyone else, because the trader was so scared about the consequence of the fact that he'd been doing this trade for a year or more under the auspices of the previous supervisor. And I thought that was an unfortunate consequence, because the reality was that the trader would have been much better off escalating that issue as soon as he started to have concerns. But the reality was that he was paralyzed from doing that because of the fear of the consequences. So I think those are some practical negative impacts of ultra-aggressive enforcement that we're currently seeing. And no doubt we'll find an equilibrium in the coming years that will be right.
Joe, what's your
I
comment?
think they're all excellent points that Peter and Matthew has made, and I suppose I've just been writing some notes to take the discussion a bit further. There's no question that the industry's self-confidence in business decision-making has been shaken by the last 5 to 7 years, and some of the points Matthew was just making then are all valid. I mean, there's a new line drawing going on, and what used to be acceptable a few years ago is no longer acceptable. And I remember who would have thought, even as recently as 5 years ago, that antitrust and competition law would be as relevant to banking as it is today. I mean, 5 or 7 years ago, no one talked about antitrust and competition rules having much relevance to the life of a banker. But we now know that that is wrong, and that we have a whole range of very significant matters that have come through the system involving rate fixing and benchmarking and various trading activities, which are clearly collusive and are not in the interests of a fair and orderly market or in the interests of clients. And so it's been a bit of a learning experience, I think, for a lot of people to look at our business model, look at the bank's business model, and say, well, what really is in the interests of clients and the market, and what is the right thing to do? The second thing I would say is that there is a philosophical question, and Matthew's touched on this as well, is what we expect from banks. What is it that they're really there to do? And so once we've figured that out, well, clearly we want to encourage that, whatever that is, and that could be assisting the raising of capital, lending money to businesses, providing basic retail services to people. And we all need a bank account and credit. Although there's new players in all those areas now with fintech and everything, the whole world's going through a revolution. But my point is, what banking services do we want to encourage, and what banking services do we want to discourage? And I think the last 5 to 7 years has really brought that debate right to the forefront. But in the end, I think, does enforcement stifle market competitiveness? I don't think is the way I don't agree with that. I think the banking sector has learned a lot the last 5 to 7 years about what's acceptable and what's unacceptable. And I think we will continue to see innovation, in good innovation, not innovation driven by complexity, but innovation driven by actually wanting to meet the banking needs of the general community. So it's as far as I can take it today.
Meena, Joe raised the question, what do we expect from the banks? What do we expect the bank to do? So from a banking regulator's point of view, how do you see the proper answer to this open question?
Well, I think that I definitely don't think that strong enforcement stifles market competition. I think strong enforcement is part of the regulatory system, and it actually is good for competition. It attracts investments. Take, for instance, our strong AML legislation, AML and CFT, and enforcement. I think it enhances Hong Kong's status as an international financial center, and makes people want to come and do business. On the other hand, if we didn't have that, then we would, we would be not part of the global community's efforts to combat AML and CFT, and it'll be dire consequences. People won't want to come and do business with us. We could be named and shamed. We have a mutual legal evaluation coming up in 2018. We really have to have more, enforcement in this area.
Thank you. Now, the third topic is what should market participants do to reduce the exposure to enforcement actions? Before I do that, I would like to show you, yes, not this one first, sorry, not this one. I'm told that I'm to show you a PowerPoint which indicates the number of SFC investigations over the years. This is my 2 minutes advertisement for the Securities and Futures Commission.
It's going.
You can see that the figures is on the rise from the figure of 262 in 2010 to 11, all the way to April 2015 to December last year. Just 9 months figured is 722. I think you can go home and calculate the percentage increase, but the bar chart shows quite clearly that it's quite a substantial increase. And the areas of investigation are corporate disclosure and governance, insider dealing, market manipulation, intermediary misconduct, and unlicensed activities. And the following chart shows the listed companies' investigations. Again, it's all on the rise. So in terms of enforcement action, insider dealing investigations, market manipulation, you can see from the charts, it's actually every category is on the rise. The SFC is very busy. We are engaging in a lot of enforcement activities. Now, so in terms of, we have actually a polling result. We set out 4 categories of advice. One is spend more on training for frontline staff, to spend more on legal and compliance. And 3, spend more on IT to address internal control and problems. 4, not are concerned with lawyers to deal with that. Well, luckily, it's only got 4%. Apparently, lawyers is not in huge demand in this area. Apparently, training for frontline staff is most important. Now, as I said, if we can go away from this seminar with one advice from each of you, if there's one advice that you can give to the participants in the seminar, as what advice you would give them to go away and pocket it. So say that, well, these are the measures that I should go home to advise my company to implement so as to avoid or reduce the risk of enforcement. What would that one advice be? Perhaps let's start with Peter. What would that one advice be if you were to give that advice?
Well, I'd ignore A, B, C, and D and just say obey the law. No, seriously, I think in the Australian context, a key piece of advice that I give firms is we don't expect that you will always get it 100% right. We don't expect that there will never be a problem, that there will never be someone in your firm who engages in misconduct. So things will go wrong. The issue is, from ASIC's perspective, from an enforcement perspective, how do you respond to that? Do you identify it early? Do you, in effect, support the people that may have brought the matter to your attention? Do you report it early to the regulator? And do you then engage it constructively? So that's the issue. Do you have a constructive response and a rapid response when things go wrong? And in particular, do you report it to the regulator in a timely manner? It's been enormously frustrating in Australia where firms have waited a year or more before reporting misconduct. That is not going to get you off on the right foot when it comes to a potential enforcement response.
Thank you, Peter. Matthew, what's your free legal advice to the audience?
Can I cheat and do 2?
Yes.
The first one is just an observation, and effectively it's an outsider's amateur observation on controls. I always see things when things have gone wrong, but my observation, born of years of experience, is that when things have gone wrong, I rarely find that there was that much wrong with the policies and procedures, the general framework. It's all okay, that stuff. That could all be improved, but that stuff tends to be okay. Where I see the problems arise is implementation or adherence to the policies and procedures. And I think most firms are underweight monitoring and surveillance and overweight the paper, the policies and procedures themselves. And I think that in terms of controls, a lot can be gleaned from watching what your people are doing. This sounds big brotherish, but I do think that reading emails, listening to audio, and looking at chat on a random basis is likely to bear fruit and likely to repay investment in terms of identifying cultural problems. So that's an observation from an enforcement defense lawyer's perspective on controls. The second observation is, I think the answer is ultimately concentrate on culture. And by that I mean the behaviours that are really important to having the right culture. And if I just pick one, it's a bit trite, but I think it's the absolute cornerstone of all this debate, and that is ask yourself the right question. So fundamentally, that's the old chestnut of should we do this, not can we do this. Very quick example, not that long ago, I was involved in something where we came across a situation where a trader had a synthetic exposure to a particular name. The trader learned legitimately in the course of his business that a big block of that name was going to be sold in the market the following day. The trader decided that the wise thing to do to offset the synthetic exposure was to take a short position on that name in the cash, because that would inevitably pay off the following day when the big block of that company was sold. Sure enough, the bet paid off. The boss of that individual, very senior individual with that institution, knew about all the facts I've just described. When this was found, when it was discovered, there was some scurrying around by the institution concerned, legal compliance, senior management, risk, all were involved. And they all asked themselves the question, was that insider dealing? And the conclusion was reached reasonably quickly, actually, in the circumstances, it probably wasn't insider dealing. So everyone just breathed a sigh of relief and moved on. Nothing happened to the individual, nothing happened to the boss. And no one stopped and asked themselves the question, was that an ethical trade? Because it was a seriously bad trade from my perspective, and a trade that exposed the organisation, whether insider dealing or not, to a level of regulatory scrutiny and the like that was dangerous for the bank. So I just thought everyone involved there, from the control functions to management, had asked themselves the wrong question. If they'd asked themselves not the is it legal question, but the was it right question, they would behave differently.
Thank you. Joe?
Now, again, I agree with Peter and Matthew, all excellent points. I'll try to add to them a couple of my own. One is internal accountability. I think you need to have, it's a sort of a variation of Peter's point, but when things go wrong internally, you want to have a culture or a practice where people are held accountable for when things go wrong, and you have a proper process to make sure that happens. And you don't want people thinking, oh, that fellow over there made a mistake, quite a serious mistake, and nothing happened to him. Or worse still, you have the opposite situation where you have an inconsistent approach to dealing with accountability, and then you develop a culture of unfairness and lack of trust in senior management. So this whole area of internal discipline and accountability coming out of things going wrong, I think is a very significant subject, and we've seen a lot of case law being generated and terminations coming out of the financial crisis where, I think that the banks have had to learn a bit about how to do that correctly. My only other tip, which particularly in organisations that banks tend to be large, complex, multi-jurisdictional organisations, operate in a variety of countries. And one of the things I've noticed over the years, which really shocked me until I got used to it, was that a lot of the time, managers or supervisors of businesses within those organisations can be very successful. But they have a superficial understanding of their own business. And so I think the key tip I would give people is, do you really understand how your business makes money? Yes. Do you understand your own business model? And what I mean by that is, do you understand, again, it's a variation of what Peter said earlier about obeying the law. But if you're supervising or managing a complex business that's profitable, but it's still a highly regulated business by definition, so you ought to understand how you make money, are the rules, policies, procedures of whichever countries you're operating in being observed. And if you start thinking like that, then you've got a pretty good chance of getting it right most of the time. Yes. But if you go into running a business being a little bit not so concerned about how you're making money, then you're going to get yourself into trouble. And a variation of that theme is your top performers are the ones to watch. Because you should really understand, well, how do they make so much money? Why? What is it about what they're doing is making them successful? And a lot of the time that may be perfectly fine. But you don't want to wake up one morning and find out that person was making money in an improper manner because you weren't supervising him or her properly.
That's excellent advice. Meena, from perspective
I've got 15 more seconds.
You can have more than that.
Well, seeing that I've been sort of, saying that culture is very important, I think that it all stems from the board of directors, senior management. So I believe that, if there's any takeaway from me, it's that, the corporate governance system, so that, the right culture is promoted, the tone from the top, walking the talk. It covers everything, training, incentives, everything, because it cascades down to the middle management and then the front line. But it has to come from the top.
Excellent. Thank you very much for coming to this seminar. May I sum up by saying that the polling result, which is a democratic process, concludes that more enforcement is welcome. And that's a good news for Ashley and Counsel. And we would strive our very best to build up this culture by applying more stringent enforcement. And then you have the benefit of this seminar by having the advice from a very strong panel of specialists from across jurisdiction and also locally. Thank you much for coming to the seminar. Thank you.